100, Dow Jones 30 and S&P 500 continue their downward trajectory. We recognize that there are a number of fundamental factors that could affect US and European stock markets, and we are to discuss the fundamental environment surrounding Tesla and Meta. Tesla has missed its Q3 delivery expectation that had been set by market analysts. Furthermore, the company's deliveries were nearly 7% less than the previous quarter, which may be a source of concern for the company, which is also facing potential issues from an EU probe in the Chinese subsidies received by EV car makers, as we had reported last week. According to a company statement, the cost behind the decline was attributed to planned downtimes for factory upgrades, as discussed on the most recent earnings. In addition, the company stated they were still on target for the 2023 volume target of around 1.8 million vehicles. The expectation that the company is still on track to meet its target volume could provide some respite to investors, which may have been on the edge since last week. However, the fact that its deliveries came in much lower than the last quarter seemed to be weighing on the company. Furthermore, we know that in the recent days, news outlets have been reporting that Tesla Gigafactory in Germany has seen a high frequency of staff injuries. The potential safety issues in question could weigh on the company's ambitions to meet the target. As such, we remain skeptical of the company's claims that they are still on track to deliver near 1.8 million vehicles by the end of the year. On the other hand, should the company in the earnings report in 2 weeks' time indicate that they are still on track to deliver the aforementioned volume of vehicles, we may see the stock gaining some support. Meta, according to a report by Reuters, is preparing to charge EU users $14 a month in order to access Instagram and Facebook on their phones. The report also goes on to claim that users will be charged $17 to be able to use Facebook and Instagram on a desktop. However, the report also states that the fees will be optional for those who do not wish to be targeted by ads, whilst those who consent to their data being used by the company will still maintain access to the free versions. The potential move by Meta could have disastrous consequences in the short run for the company, as it may lead to a decline in its user base, which could weigh on the company's ad revenue. Although over the long run the company could potentially increase its ad revenue, as it in theory would be able to use the data gained from users who are not willing to pay the free for ad and free services, whilst benefiting from users who are willing and able to pay for the ad-free services. The potential increase in revenue, should it occur, could support the company's stock price. On the other hand, should the company face public backlash and be forced to abandon its proposed service, we may see the company's stock being weighed down. We should know that at this point in time, no final decision has been made by the company, and as such, if no public announcement is made and at the end of the day the alleged plan is scrapped, it may have little to no impact on the company's stock price. Thank you for watching.